Good afternoon, everyone. My name is Marissa, and I will be your host and administrator today. Welcome to the February 2024 First Friday webinar. Today's presentation is titled, When Does the Cure Become the Poison? Our prepared comments today will cover inflation, the coming recession, and the cost of bringing our U.S. economy out of the next several recessions to come, along with the U.S. Federal Reserve's most likely course of action when confronted with each downturn. This session will be recorded as other families who are unable to attend have asked us for the recording. Please note, we will not record your questions as privacy is always a top priority for our firm. One more update for all family office members and participants today. Each of the First Friday webinars are recorded and available on our website for family office members and friends. As an additional help, we have started to summarize our First Friday discussion each month in a publication titled Footnotes, for those who would rather read the discussion's topics as opposed to listen to the webinar recording. The Footnotes publication will include a summary of each topic, along with most of the supporting slides from the presentation. It will be available on our website along with a recording of our webinar approximately 5 days after the First Friday presentation is completed. Please remember, these offerings are for your use only, and we strictly prohibit distribution of these materials. So please don't send these informational offerings to anyone outside of your family members. Our prepared remarks today will be a bit shorter, as we have already received questions which we will answer at the end of the prepared remarks. If you have already sent us your questions, we want to thank you. Your questions truly help us understand what topics are most important to each family we serve. If new questions arise from the content of today's presentation, please either send the question along by typing your question into the chat box at the bottom of your screen, or write it down and raise your hand by clicking on the icon at the bottom of the screen. We will do our best to get to your question at the end of our prepared comments. One final note, please remember to mute your device's microphone and stay on mute unless you have a question, as background noise is audible and distracting. With that said, let me turn the presentation over to Stephen Abernathy, who will provide today's commentary.
Welcome, everyone. I'm Stephen Abernathy, as Marissa said, and this is the February 24, 2024 First Friday meeting for all of our family office members. Today, we'll plan to discuss information which we hope will help each family separate the signals from the noise in an attempt to understand what is taking place within our U.S. economy, whether a recession is in our future, and the costs associated with our government bailing out our economy each time we we scratch our knee or we enter a recession, and whether this babysitting effort by the United States Federal Reserve can continue. We also want to spend some time on whether the U.S. Federal Reserve is winning the battle against inflation, as inflation continues to be the cause of our Fed's dilemma at the moment. And at the end, we should have always a short discussion about the risks of being wrong about the outlook we're calling our base case. So first, is a recession in the U.S. economy likely during 2024? We continue to focus on the data, which has the highest probability of telling us what is to come as opposed to what's already happened. People's focus on what has already happened is the source of most monumental mistakes for all investors. We believe, and the data support, taking the time to understand the difference between lagging data, which describes where we've been, and leading data, which describes the future. For our discussion today, and since we've gone over this information so many times before, we'll stick to separating the signals from the noise. The signals, while there are many data points which offer information about what lies ahead, the most reliable two signals and the supporting logic which translates fundamental factors into economic outcomes. And this is really important. The data need to make sense to you as logical humans. The two outcomes or the two signals that we have found are the most reliable are the yield curve and the leading economic indicators. I'll spare you, uh, as most of you are my friends, I'll spare you with the definitions and probability coefficient for each of these signals or each of the noise. However, despite the contradictions by the press and the talking heads, both of which tend to follow shiny objects every time they appear on the screen, um, which they believe offer newsworthy data. Um, we describe this as noise. Um, and along with every minute um, of, of specific data, which is important to the headlines today, um, most of the lagging indicators are seldom remembered even one day later. So the lagging indicators tend to get the most press and the most attention. This takes place before a downturn to come and before an upturn to come. So almost in every situation, and I've been doing this for over 40 years now, in almost every situation, you'll find a focus on the lagging indicators or the coincident indicators before a turn takes place. It is I urge you to find the people who are following the leading indicators and or listen to what we have to say, because this information is tied to the future. It's about what's to come. The yield curve is still inverted, and it provides approximately 80% probability of a recession to come. The leading economic indicators also offer negativity for over 18 months in a row now. And I just want to make sure that I tell you that history tells us that there's a 100% probability of this signal providing information that a recession is to come. It's never been since uh, the date that we started acquiring or accumulating the data to make the leading economic indicators, of which there are 10. And I don't know how far that goes back, but I will tell you that it is incredibly accurate. Of course, when you're dealing with economics, there is seldom a 100% chance of anything ever happening. So I don't want you to say that we're guaranteeing that there is a recession to come. It is just highly, highly probable. And despite all of the contra indicators that are out there, these are the two that you should be watching. This is not the most reliable indicator, but it is certainly a coincident indicator. Bankruptcies have already begun increasing, and they're going to continue to increase in 2024. We've discussed the fact that debt leverages outcomes both positively and negatively, and the current amount of national debt combined with corporate debt, combined with personal debt, will increase outcomes and volatilities both up and down. And um, bankruptcies are part of that process. Our base case for 2024 or 2025 is that markets are going to go up and down with no gains. And and if we do avoid a recession, or if we have a recession and we think it is a heads, a coin flip of being a mild recession, um, the markets are still going to correct between 25 and 40%. This is not a reality, but it is a high likelihood that this will happen. And we're darned and determined to help each of the family office members avoid that with their current allocations. So let me move on. In summary, the leading economic indicators that are most relevant are still pointing towards a recession. Nothing's changed. things have continued to evolve in their favor. However, the lagging indicators and the coincidental indicators are certainly telling you that things are okay and our economy is wonderful, which has its own implications, which is likely to lead the Fed to push rate decreases out in the future and keep rates higher for longer. And the longer they keep rates at these levels, the higher the probability is day by day that you have something in our economy break. And when something breaks with the amount of debt we have in our system, trouble follows. What are the costs for rescuing the United States from a recession? Of course, um, the question or the answer is unknowable. We know that the deeper the recession, the more bailout funds are required. The problem is that the major topic, this is the major topic in our presentation today. And here are the facts. We have a national debt which exceeds 34 trillion today. And as you've seen this slide one time or two times before, I hate to bring it back up and back up. You must remember that it took us 200 years to create our first $1 trillion in debt. It has taken us less than 50 years to create 30 times that amount. And maybe the way it affects me is significant. Maybe we should just allow you to let that sink in for a bit. So again, over the last 50 years, we've increased our debt by 30 times. The point's this: sooner rather than later, the world will not allow us to continue to increase our debt. That will come. It's not here now, but it will take place. And as we bounce along today, our political administrations, both Democratic and Republican, this is not a political statement in any way, shape, or form. No one has a plan to either decrease our deficit or decrease our budget or decrease our debt load. Neither. What that means is that as we go into this recession, and and we will fix it. I have great confidence that the world won't end. We'll fix it, but we will exit the recession with the same, or I believe, 3 to 4% more debt. This is going to end badly. What it means is during 2024, it's likely that we'll have another $1 trillion in deficit spending during the year. And if we have a recession, as I just suggested, the most reliable signals in this deficit is going to start doubling or tripling. So when we go into 2024 with a $1 trillion deficit planned, if we have a recession on top of that, that deficit's going to be 2 or 3 trillion. And while this is terrifically bad, each recession to come is going to force us to dig a deeper and deeper hole. Tax revenues will continue to decline, and interest rates on our debt, along with our social programs, our commitments, will continue to grow in costs. The point we're trying to make here, or the point I'm trying to at least relate to you, is that the next recession is likely to be a reasonably mild one. The Fed's aware of it. It's the most publicized recession that I've ever seen. We expect the Fed to come to a rescue and lower interest rates while infusing needed liquidity into our ailing economy, which will again increase our deficit. And it's the deficit which is creating our problems. So each successive recession will come, or each successive recession to come, will increase the odds that the world at some point will shut the door on our borrowing. This will be the moment of truth, and it's one we need to avoid at all costs. I want to be very clear. I have no idea what exactly will happen at that moment, yet I will tell you that the range of outcomes within the probability set of outcomes starts with bad on one end and ends with disastrous on the other end. There's no way around it. There's again, this is when the cure to our recessions become poison. There's a lot more to be said about the politicians consistently increasing our debt levels to which, um, you know, to levels that we can't repay. However, I hope each of you is getting the point. Borrowing money pulls future revenue into the present, and it robs the future of the revenue it's stealing from the future. It can't go on forever. And as the law of energy says, if something can't go on forever, at some point it will stop. And when over my final statement on this matter is when an over indebted entity realizes it can't repay its debts, it ends badly. Let's take a minute and go on to the next question and rush through this. Is the Federal Reserve winning its fight against inflation? And the simple answer is yes. We believe inflation is going to continue to move lower over time, yet we don't believe it will move lower at the rate the markets believe. Here's where we differ from the marketplace, and there's lots of data supporting this. In short, we believe it will take longer to reduce our inflation to the 2% level defined by the US Federal Reserve. This means it's likely that there will be fewer interest rate cuts than the market believes, and it's likely they're going to be farther out than the market believes. This will eventually cause problems with the marketplace that's considerably overvalued at the moment. So what happens if we're wrong? This is as I humbly and always kind of go over with each of you. It's always a great question to ask before any and every significant decision is made, because the reality is that there's almost always a chance of being wrong. Regarding the probability of our being wrong, um, I humbly say that it's incalculable. And the reason is that we're dealing with an economic system. Economic systems are open systems, meaning there's no set of variables that you can balance and work with mathematically. And consequently, the ability to determine a probability of any outcome in an open system is incalculable. However, what we can determine is the downside or the risks of being wrong. And this is another chart that you've seen similar data from. This is called the Buffett indicator, and it is a very broad, just sort of gut check on how the world sees the public markets right now. And as you can see, it's between 1 and 2 standard deviations overvalued. Since the stock market is overvalued, and if we're wrong and do not enter a recession, we don't have much upside to miss, in our opinion. A soft landing is already priced in. So you've heard people say that the market is priced for perfection. I'm not sure whether it's priced for perfection or not, but it's priced for a really good outcome already. So my statement to those of you who are interested in making sure that you don't have to go out and make it all again, be conservative. This is not a market that is 20 or 30% undervalued. This is a market that's 20 or 30% overvalued. And chances are earnings that are supporting this overvaluation are going to come down. And when the earnings start to come down, and there's likely to be hell to pay. Let me make one more comment. If we're wrong, well, our portfolios for most of you on this call who are my friends and who are part of the family office, we've structured our portfolios with the ability to avoid any significant downturn by owning securities and public guarantees and public equities that have a 4 to 6% return on our invested capital. So in short, if we're wrong, we're going to receive a 4 to 6% return. And if the leading indicators are right about the future to come, we're going to avoid a downturn, which is likely to be mild, the first one, yet it could be significant. It's the second or third order effects of this downturn that will affect our next downturn that I want you to be highly sensitive to, because as we will probably figure out our way through this next one, the one after that or the third one after that, at some point, the costs, as I said, become poison. Let me take a moment here and ask Marissa if there are questions, as I believe there are one to several, and it would be great to see if we can answer these questions.
Yes, we've got a couple questions so far. So the first one says, we've been hearing about a coming recession for quite some time. If a recession is still in the cards, what factors are still driving the markets to continuing all-time highs and to be overpriced? And then it's a two-part question. So the second part says, what will cause those factors to fail?
Okay, so that's a really deep question, and and again, this is not, I'm not saying this just to placate the questioner, but it's a really good question. And it's one that I work on almost, certainly every week. Here's the thing. There's been so much stimulus that's been pushed into the marketplace, and I don't think that's ever been done before at these levels and from this many different dimensions. So there's there's been rent forgiveness for 2 years through the pandemic. There's been eviction and foreclosure moratoriums, which allow people just to kind of hang around in their apartments or their rental units for free. There's paycheck protection. There's student loan forbearance, which is pushed off or forgiven tens of billions of dollars. And that's before the actual stimulus payments came in during the prior administration. And since the prior administration, the current administration has the Chips and Science Act, which is 53 billion. It's got the American Rescue Plan, which is 1.9 trillion. It's got the Infrastructure Investment and Jobs Act, which is 1.2 trillion. The Build Back Better Act, which hasn't it's passed several levels, but it hasn't been signed into law by the president. It's 1.5 it's 739 billion. I'm sorry, the Build Back Better Act is 1.75 trillion, and the act is 739 billion. The bottom line is, I guess, the numbers aside, what you can see is there's so much money that is being pushed into the economy that, I mean, you're talking about a 10 or 15% of our gross domestic product being pushed in to our economy. So the bottom line of this is, I don't think I certainly know that we haven't seen any kind of stimulus program like this in our history, for sure. I don't know whether we understand how long the consumer can continue to spend, but I will tell you that the consumer is is continuing to spend, and they're continuing to spend on debt. Debt levels at the citizenry, at the consumer level, are at record highs. And one of the leading indicators that gets very little press is called gross domestic income. When gross domestic income, which describes wages, is less than gross domestic product, we always have a recession. And it makes sense. It means that people are getting paid less. They have less to spend. That GDI, or the gross domestic income level or number, has been negative for 8 months now. It's unlikely that we will avoid a recession. I'm not sure whether that answered the question, and if it didn't, if the questioner is online and has a follow-up question for that, or tells me that that doesn't help it, help me come back to it. Marissa, what was the second part of the question?
The second part of that question was, what will cause those factors to fail?
I think, well, I know the consumer, we're consumer 70% of our economy. So it will be on the consumer. Um, and that's it. So the only thing that will allow those factors to fail outside of something breaking in our economy or outside of something geopolitically happening, which there's no shortage of geopolitical challenges in front of us. They don't get any weight in the risk spectrum. And there's all kinds of sort of income oriented problems with bankruptcies, with car loans, with the price of housing. All of these things cumulatively make up some frighteningly bad odds for the headwinds to come. I hope that answers some of the question, and if it doesn't, come back to me. Is there another question, Marissa, or
Yes, a few more.
more?
So
Okay.
first one, how should we make sense of what seems to quote unquote feel like a precarious economy when banner headlines today tout January jobs growth of 353,000 and unemployment at only 3.7%, which seems at odds with reports that Google, Meta, and Microsoft laid off an additional 24,000 workers last month.
Well, I think that you have a tale of two economies. The um, First of all, I don't know. This was a new number this morning, and I haven't had a chance to kind of go through that. I was more or less preparing for this conversation today. Um, I don't understand, um, other than the factor that I know it sounds like a conspiracy theorist, and I don't want to go too far down that rabbit hole, but the numbers of people that are filling out their questionnaires has been cut in half. The reason I bring that up is that when you go from 50% ish questionnaires being sent out and filled out and returned to 22 or 23%, it's likely that the people that are returning them are are in a better mood. The people who have dropped out are likely just to be disgusted or um, uncomfortable for some reason. Again, it sounds conspiratorial, but I will tell you that the odds or the amount of questionnaires that are being returned are dwindling, or they've been overcut in half. So I don't know the answer to that question. It's a good question, and I can tell you that if we move into a recession, as I believe we will, more jobs will be cut. for sure. Let me go on to the next one, and if that answer doesn't answer your question, which it probably doesn't, um, please come back to me.
Okay, another question for you. Consumers are still spending, but credit card debt has increased 30% since 2021, hitting 1.1 trillion today. What should we make of that? Also, how should we think of that in consideration of rising corporate and government debt?
It's all it's again, we're funding our current activities with future revenues. This is this is the opposite of how you want to build a civilization. This is the opposite of what of how we want things to to progress. Over the course of the last 10 or 15 years, we have we've pumped moral hazard into our economy, and we've pumped so much money into our economy that that something called creative destruction, it just never happened. So moral hazard takes place when you incent someone to take a risk, and if they take the risk and they fail, we bail them out. This has happened time and time again. It is infuriated, tens of millions of people justifiably in the uh, in the banking system. These people took huge risks with money that wasn't theirs, and the government continues to bail them out. We continue to bail out our economy each time we, skin our knee, and and if you'll go back and look at what happened, the reason our Federal Reserve was created in the first place was a lender of last resort. This was the entity that would come on to the spot, when the world was getting ready to end. It is not created, or it was not created to manipulate our economy as it's been. So, in short, my quick answer is, when you have 0% interest rates, it is incenting speculation or risk taking, and that's fine. But risk taking with moral hazard on top of it doesn't work. It destroys capitalism. The second thing is creative destruction. We have to let creative destruction describes the process of companies that can't deliver products that are value creative to go away. And it's painful. I get it. You spend your life or spend your time creating a product that gets over come by another product, and it is painful. I truly understand it, but it's necessary. It's progress. If you don't allow that to happen, and by giving these companies 0% or very low interest rates, they've built companies where the profit margins are so thin that they can live on 2, 3, 4% interest rates, and that's just not fair. Um, it it brings society down. So the bottom line is, if any of you are interested in more information about that, let me know. I've got a ton of information on. It's called Shumter's Creative Destruction Law, and it's pretty interesting. Anyway, I hope that helps. Marissa, what else do we have, if anything?
Okay, yes, I've got one more question for you. What are
Okay.
the known risks confronting investors today, and what is being possibly overlooked by the capital markets?
Wow, that's one we went over last month. I think the most immediate risk that's front and center is earnings. Earnings dictate valuation, or dictate corporate valuation or asset valuation. Um, if earnings come under siege, valuation is going to decline. Um, I think that the moral hazard that exists today with the Fed, that they're darned and determined to come to the rescue every time we, as we said, skin our knee. I think that they will. I think that if we fall into a hole and earnings start to crater, I think the Fed isn't going to worry terribly about that. I think if something in our system breaks, the Fed will come running with, a bucket of cure. So the risks in front of us today are are if you're in the stock market, you're likely to be in an overvalued public entity. That's the case. If you're in the private equity market, I can guarantee you were. I spent all day with with 7 or 8 companies in the private equity space yesterday, and every one of them admits that things have gotten out of control, and it's probably about 40 or 50% overvalued. That's okay. They don't trade every day, so people are going to just ignore their current valuations. When they get the statements, they'll be happy that it looks like they're making a lot of money, but they're really not yet. Um, that will shake out. So the private equity market is going to shake out. The public equity market is going to correct. It'll get back down to its 14 or 15 times earnings, which is the right thing for it to be. Oh, that's the right place for it to be, to offer incentive for people to invest. And outside of geopolitical challenges, which it 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 appears to me that we're moving into a period where there's going to be more geopolitical strife than less. So today, I think, as we look forward into 2025 and 26, I think it'll be a low point, not a high point. And then we've got elections. With a politically divided country, I I don't know. I've been hoping for someone to come out of nowhere to become our savior and pull everybody back into the middle so we can talk again and we can find solutions, but it doesn't look like it's going to happen. I'm losing faith. So those are the risks in front of us, I think, from my view. Anything else, Marissa?
No, those were all the questions today.
Okay. With that said, thank you all for attending. If there's any follow-ups with what I've talked about or the answers I've given, which I'm sure there should be, I probably haven't done a good job on that. Please let us know. On the other hand, we'll see you next time, next month, for the first Friday publication. And if you'd like to, if you'd rather read these things, these comments or these sessions, rather than listening to me stutter and stammer, please look for the footnotes publication on our website. It's not bad. Thanks a lot.